If you are bullish on a stock, index, or ETF, the first option strategy that typically comes to mind is the long call. But there are other strategies to consider, particularly if you expect a sharp upward move and want to incur a lower cost to participate in your bullish forecast. With the callback spread, the risk is defined and limited, while the reward increases as the stock, index, or ETF increases. The callback spread can sometimes be set up as a no-cost trade, whereby an investor creates a ratio of 1 short call and 2 higher strike long calls. This is a 1-by-2 backspread. The idea is to finance the 2 long calls with 1 short call. Depending on the strike prices chosen, the investor may enter the trade for little cost, no cost, or sometimes even a credit. But it is more important that the choice of strike prices matches the investor's outlook for the stock. By design, the short call increases in value as the underlying moves higher. However, the combination of the 2 long calls will typically offset the loss on the short call to a certain degree, and eventually the position acts like 100 shares of stock if the move is large enough. If the investor is wrong on market direction and the stock is below the strike price of the short call, the investor might break even, or in the case of taking a credit at the onset of the trade, may even achieve a profit. However, be aware with only a moderate move higher, the trade can have a loss. Let's look at an example. Suppose an investor is bullish on XYZ stock, currently trading $62 per share. To create a callback spread, the investor sells a 65 strike call for $2 with 90 days to expiration. At the same time, the investor also buys 2 70 strike calls at $1 each with the same expiration date. Once established, the investor has the XYZ 65/70 callback spread for a net cost of 0. The best scenario for the callback spread is if the stock moves sharply higher by expiration. For example, if the stock rises to $80 per share by expiration, the short 65 strike call is worth $15, but the long 70 calls are worth $10 each, netting a $5 profit between the longs and the short, or $500 per spread. Remember, the investor does not have to wait until expiration to take the profit on the trade. If a move higher in the stock is sufficient enough for the gains of the 2 long calls to offset the loss in the short call, then a suitable profit can be taken at any time during the life of the trade. It's at expiration where the greatest losses occur between $65 and $75, with the maximum loss at $70. That's because the investor would lose $5 on the short call while the long calls would be completely worthless. Above $70, the long calls are in the money and completely offset the losses on the short call at $75. Because the maximum loss doesn't take place until expiration day, the investor may consider closing out a call ratio backspread well before expiration. If the stock closes at or under $65 at expiration, the investor would break even on the trade, and the only investment loss is perhaps the commissions paid to enter the trade. This type of trade has been typically placed in advance of a very positive earnings outlook or product announcement in anticipation of a swift and dramatic move in the stock. If you happen to be looking for an option strategy for a bearish outlook, you may want to consider viewing the put-back spread video. To learn more about the callback spread and other strategies, visit the OIC website at optionseducation.org.